Welcome to Vital RE, where we talk about real estate, mortgages, and everything in between. If you're new to the channel, subscribe, hit that like button. Let's begin. But before I begin, I want to address the elephant in the room, my shades. I normally film late at night. The lights are off. I have giant lights right in my face. It's really hard. And this is going to be somewhat a lengthy video. I want to try this out. So bear with me. My eyes are still there. They're just very, very sensitive, very photosensitive. Let's take a look at a couple of things real quick. Today, we're going to be talking about Schedule C. If you're self-employed, you're most likely on a Schedule C. What is a Schedule C? Schedule C is where you report your business, your profits, your losses, expenses. If you never started a business, and if you start a business, most likely 99% of the time, you're going to start as a 1099 self-employed, or you don't even need that. But you're going to report all your gross receipts, gross incomes, and you're going to figure out all that stuff. Consult your tax advisor. Schedule C is one of the most common ones. We'll do videos in the future. The difference between a Schedule C, corporations, LLCs, incorporations, C corporations. There's many different ones. Schedule C or a 1099 contractor or employer is one of the most basic ones. So that's what we're going to focus on in terms of how these taxes are normally done, and more importantly, what do banks look at and what they lend on. So in this case, this is Joe Schmo, or whatever it is. Either it's a truck driver, Uber driver, whatever it is. I've plugged in some phantom numbers in here. Gross receipt or gross income is going to be $80,000 for this particular person. They're going to go ahead and hire out a couple of people. Maybe they couldn't do a certain job. They had a contractor do a couple of jobs, and that was $2,300. Maybe they got paid $5,000. Who knows? If you see this, or if you have this, most likely then you hired somebody. Think of it as a subcontractor, and then in this case, you would issue them a 1099, and they would be doing a Schedule C just like this. And in their Schedule C, they're going to add this $2,300 in addition to all of the other income that they've done. But this money went out. So although the money came in, you paid out $2,300 to a contractor, you don't get taxed on this. The most magical number on the Schedule C is depreciation. If you purchased a vehicle, there are certain rules and laws around that. You do not pay taxes on this, but the beautiful thing is we add back depreciation to your income when it comes to lending. And we'll take a look at that formula in just a second. If you bought a vehicle and it's over for business and it's over, say, 6,000 pounds, again, there's certain rules apply. We can take an accelerated depreciation, write off the whole thing, or write off over 5 years, your choice. If you bought a laptop, if you bought a phone, say you bought a new iPhone for $1,200, right? You can take an accelerated depreciation, write it off completely, not pay taxes on that. So that's going to get deducted from your gross income, but we add that back in there. Say you have a bond or insurance, that was another $1,000, taxes or whatnot. There's a license involved, $250. Meals and entertainment. This is a very sensitive subject. If you like to eat out a lot at restaurants, wherever, you can actually write all of those events. Because anytime I go to a restaurant with my wife or my family, I'm always talking about business. Business is always on our minds. So guess what? If we're talking about business, I always write that expense off. Maybe not always, but oftentimes I do. But if we're talking about business and we're discussing, and we always are, say I drop 120 on a dinner, a fancy restaurant. We talked about business all evening, which I try not to talk about it, but we always do. I deduct, say, if kids ate for about $45, I deduct that. So I'm going to write off all of that. Now, 21 was a special year. 100% of your meals can be written off for business if it's business related. Years prior to that was only 50%. Who knows what's going to happen the following years? So consult your tax advisor. And I have, say, like a 300 square foot room that's an office designated only for my business, that I work there, take calls, do accounting, whatever I do in that. There's special rules applied to this. The magical number is this one, line 31 on the Schedule C. So you made $80,000. After we deduct all of this, your net income, $28,590, and you're not paying taxes on this amount, because if you're married and you're filing joint, you don't pay taxes on the first $24,000, I believe, right? If you're single, I think it's like $12,000 something. In this case, you're only paying taxes on anything above 24 or 24 something to this amount. So you're paying minimum taxes on this, and I'll show you how the banking and the lending world looks at a Schedule C such as this. This is Joe Schmo, and this is the formula that we use. I call it the SAM method. This formula is provided by MGIC. Go look them up. And all banks do is they just take your numbers from Schedule C or whatever form they're looking at, and they're just going to plug it in here. Whatever this tells us, these are agency guidelines, right? So bank isn't trying to sit there and decide, hey, I want to give you this or this. They all follow the same rules. In this case, we already know that the line 31 was 28,590. Then I'm going to add back the depreciation, which was 46,500. I'm going to deduct the meals and entertainment. Again, this is a sensitive subject because people who eat out, so maybe they spend $2,000 to $3,000 on restaurants. It's your choice how much you want to write off. And if you can truly justify that there were business expenses, you write that off, that's going to be counted against you here. So it's up to you if you want to write anything off at all. Business home of use, we've added that back in. Here's another interesting thing. So when it comes to depreciation of your vehicle, you have two choices. You can either take the miles, and there's a special formula for that, or you can take actual depreciation over 5 years or accelerated. Consult your tax advisor on that. But in this case, I got the Schedule C, and this person said, hey, I actually have 10,000 miles on here. I'm not depreciating my vehicle. I drove a ton. Well, fantastic. I'm going to put the $10,000 miles in here. The system will tell me how many cents per mile, et cetera, et cetera. In this case, and I think this is slightly outdated, but I think it's a little bit higher. In this case, it gave me back $2,700 a year for that. After I calculated all of this, and before I move on, there's one thing that I want to tell you guys right away. If you've been self-employed for more than 5 years, the system may allow us to go based on just 1 year taxes. So if you start your business, maybe you have only 4 tax returns, but you're over for the 5-year mark. You tell your bank that, hey, I'm 5 years self-employed. Can you run me based on 1 year taxes? So, right. So they're going to run it through the system, the banking system, and they're going to tell you, okay, 1 year we can run you by 1 year, or the system isn't allowing you for some reason. Let's take a look at 2 years. If the system tells you that we need to look at 2 years, we're going to plug that in on 2 years, and it's going to take an average. If the previous year was less, no problem, we're going to average. If the most recent year is less, we can't average. We're going to look just on the recent year, which is less, and then the bank is going to do several other things to figure out, hey, is this income even usable, or are you on the downtrend? If you're making less on money, they're going to look at your P&L. They might look at your business deposits. If you're trending down and your business is suffering, you might not be able to use this income at all, and that's unfortunate. But hopefully your business is increasing, your income is increasing, your gross is increasing, all of these numbers is increasing, and if not, hopefully you've been in business for 5 years and the system allows for only 1 year. In this case, this person has made $79,640 per year. If I was to plug this in this calculator, it tells me that this person is making $6,636 every month. So then the bank will take this number, 6636, and they're going to put this in this particular spreadsheet, 6636. After they plug this into the spreadsheet, they're going to start evaluating it. Okay, so this is your income. Let's take a look, before we look at anything else, let's take a look at what your back-end expenses are. Do you have a car payment? So maybe you have a car payment and it's $300. You have a credit card. Maybe you have a couple credit cards and, their minimum payments of all of them combined is $60. Don't have a lot of debt. The number one thing they're going to keep an eye out is this DTI ratio. So I'm going to plug in $500,000 at 5% down. Let's assume interest rate is about 6%. Could be plus or minus. Say you come to me, you say, hey, I want to buy a house, $500,000. This is my Schedule C. I calculated your income is about $6,600. You have an auto loan. You have credit cards. I'm going to ask you, okay, what property are you interested in? What's the taxes on it? What's insurance? Insurance in the Northwest, Oregon, Washington is very cheap. It could be $60, $80 a month. It could be $50 a month. It really depends. Property taxes really depends on the area. So for $500,000, you could see, $400 insurance a month on a property like this. Now, I'll have a separate video on MI. MI gets calculated based on your credit score and a couple of other factors, but the system tells us what the rate is. And the rate is very simple. It gets calculated loan amount times the MI rate divided by 12. That's what this number means. And if you do 10% down, then it's even less, et cetera, et cetera. Every 5% makes a difference. In this case, this person's trying to buy a house for $500,000, 5% down. He's not being approved. Now, we're going to try to approve this person at conventional. FHA is a different beast. As you can see my notes here, the FHA is going to have a max of 56.9% of the back end. So the back end gets calculated, your credit cards, your auto, plus this monthly payment for the house. That's the back end. The front end is going to get calculated simply your monthly payment divided by income. And again, the back end is going to get calculated by your back end, all your credit cards, your house payment divided by your income. So it's very simple. Conventional allows up to 49.9% if your credit allows, if the system allows. After they run it through everything, they look at your credit profile. I've seen both front end and back end allow up to 49.9%, which is crazy. But in some cases, conventional is even better. In this case, we're trying to run conventional. In this case, let's take a look at 425. Let's really drop it. And that's all that banks are doing. They're not looking at what the purchase price is. They're looking at what the purchase price is and what all of these other factors are. We were lucky enough that the property had a monthly taxes of only $345. There's no HOA. The MI went down, obviously, because loan amount went down. Insurance, we were able to get a 6%. Now we're below 50%. So if I was to run this through the system and Joe Schmo had a really good credit, most likely the system will allow this. Now again, this is the number that they qualify you, not this number. Because if you find a house for $425 and it's a really good expensive area and the taxes are $500, you will no longer qualify. If you find a house that's $425,000 and say that it's got a $50 HOA a month and you can't get any other of these things lowered, well, guess what? That just went up. So we need extra income, or we need to lower this purchase price, or we need to lower or increase the down payment. So these are the numbers that we're constantly working on and looking, and that's what all banks do. They all follow the same guidelines. So that about sums it up, how most banks calculate your income. Let me just take these off so you can see that I do still have my eyes behind here. They're all good. They're just very sensitive, like I mentioned. So I hope you bear with me. Calculating income isn't that difficult, but the better you understand how banks look at your income, how they analyze your taxes, the better you can prepare. So if you're self-employed and you're going to tax season, if you're going to see your tax accountant or tax preparer or CPA, if you have a mindset of buying a house, you have to be very wise how you take these depreciations. So be very vocal about it. Talk to your bank. The bank will suggest what's the best way. Because if you have car expenses, there are certain ways of doing car expenses. If there's an actual expense, we can't add it back. If they're more of a depreciation, then we can add certain things back. Consult the bank before you do your taxes, and it will save you a lot of headache. It will give you a lot more income and a lot more home to qualify for. Hope you found this useful. Leave your comments below if you have any questions. If you want me to do a specific video on something, leave them comments. I'll put it on my queue and I'll get it out there. Again, hope you found this useful. God bless you all, and stay in there and go buy some homes.